Hi, my name is Eric McCardle, Managing Director of Advisor Solutions here at Simplify and author of our latest blog post, Improving Hedged Equity with a Short-Dated Ladder. Today, we're going to break down the blog and talk about some of the conclusions from our research. But first, let's define what a hedged equity strategy actually is. Simply put, it is owning an underlying exposure, typically of equity or an equity index, and then producing a hedge profile that's achieved via selling a call on the top side to finance a downside put or put spread configuration. And so what this provides investors is a degree of upside participation in the market while also mitigating downside volatility for investors who are looking to have equity-like exposure. And these have become very popular in the past few years. You'll hear them referred to as costless collars or defined outcome strategies. But again, they've become a cornerstone for many modern investment portfolios. Now, these types of strategies have their own unique risks, just like any other type of investment. And in this blog, what we wanted to do was look at what we refer to as path risks or path dependency risks. And basically what this is saying, okay, if you bought the wrong strategy at the wrong time, would you have a different outcome than, say, if you had bought another strategy that's configured in a similar way with a collar, but maybe with a different strike price for the options or a different expiry on those options? And so in doing so for our analysis, we looked at annual collar positions with the underlying equity exposure attached to them, as well as quarterly collar positions. And we found that the results varied significantly. The range between the best performing strategy and the worst performing strategy through our backtest assessment was about 60%. So again, if you had just picked the wrong investment, you would have a vastly different outcome than if you picked the right one. So from there, we set out to find a way to try and mitigate this path dependency risk. And in doing so, we tested a configuration of hedged equity that had the same collar profiles with the upside cap and the downside protection, but we struck them on a laddered monthly basis for the forward 3 months. So for example, we had 3 collars, one in January, one in February, and one in March. And as the January collar expires or fell off the portfolio, we would reapply an April collar. And what we found was not super surprising in that the performance of the strategy was never the worst and never really the best. But what was surprising is that there was a performance edge. And so in this period, we found that the monthly ladder configuration performed above average relative to the annual and the quarterly peers. What we also looked at then was the performance percentile ranking of the strategy in up and down markets. And this was pretty interesting. We found that the monthly laddered strategy had an upside performance percentile ranking, so a performance percentile ranking when the S&P was up of about 59%. So very strong degree of upside participation relative to its peer group. And then on the downside, we found that it had a performance percentile ranking of about 60%, right? And so this was very interesting to find. This was a really powerful revelation to say, by laddering your positions, you could really improve your path sensitivity risk or path dependency risk and produce an above average outcome. And basically the idea being that in doing so, you don't have to worry about what time you buy or what time you sell this type of strategy relative to all the other configurations that are available in the market today. We appreciate you tuning in. We appreciate you reading the blog. We look forward to your feedback. Thank you, and we'll talk to you next time.